Today we're talking about my favorite Forex pair to trade in June 2024. Hi, my name is Zach and welcome to my channel if you've not been here before. I am a popular investor with eToro, where I'm one of the top 5 most copied traders on the platform currently. So one of my approaches to investing is doing a multi-asset approach, meaning that I invest in stocks, and you hear me talk about stocks a lot. You also hear me talking about crypto, and I also trade Forex as well. So having different sources of diversified returns is really important to my strategy. And this is because you don't depend on just one market doing well, but instead different markets all happening at the same time. So to me, this allows you to get a better return over a very long period of time. So today we're talking about Forex. Now Forex is actually near and dear to my heart because I started my trading journey in Forex. Forex also happens to be one of those places where you can find a lot of information, and it's one of the easiest places to start because of the low amount of capital required. There was a time where I exclusively traded Forex. This was when I was in uni actually, and I made a decent return every month and allowed me to cover for some of my fees. But what I found over a longer period of time is that some of it is quite luck dependent, so no matter the systems you design, if it's just a technical analysis system, it can fail. Secondly, because I'm on eToro, because I'm managing money, it's not as easy to get in and out of the market. There are different things we can talk about like stop hunting, order books, and liquidity providers. But to make it simple, what I do right now is I hold longer term positions in Forex. And also because I am a popular investor, there's a risk tolerance that we have to keep under. This is also defined by VAR. And so I don't pump as much or as risky as I used to. And this comes in the form of limiting my leverage and limiting the amount of times I go in and out of the market. Okay, but anyway, so today's pair we are talking about is the dollar Swiss franc. As you can see from my portfolio, it is this position here. You can see it's minus 27%, meaning I've lost 27% of value. And it currently only sits at 1.5% of my portfolio. So why do I love this pair? It's because I don't just stay in this pair and hold and not do anything about it. I actually trade in and out of this pair. You can see from my history, if you go to the history column, in the last year, I've made about 13 different trades on the dollar Swiss franc itself, and I'm continuing to go in and out of this pair. It's not always worked out well for me. In fact, if we go to the chart, we can see here that there was a giant drop from October all the way to January. So that's from 0.92 all the way to 0.84 thereabouts. And this caused like a huge amount of losses in my portfolio temporarily. Of course, it recovered and we managed to sell out of those positions, but it was scary when it happened. So this is not one of those strategies where it's like in and out, quick, scalping returns. Not really. This is one of those trades that we're holding long term. So if you're interested in any part of this video, you can check out my portfolio in the link in the description below. Or you can sign up for a free virtual account just to try eToro out for yourself. So the question is, why is this one of my favorite pairs to trade? Well, you see, this is something called a carry trade, meaning that the interest differential between the US dollar and the Swiss franc means that when I hold the position, I actually collect interest on that position. So what that looks like is really this. You can see this is my position in the portfolio. It's just one, I have 2 right now. It's $4,000. Of course, it looks like I'm losing $1,500 on this trade. But if you look here, I'm actually getting refunds, meaning I'm getting paid to hold this position for about $1,000, which is, not terrible as losing $1,500. But here's the thing, we've been trading in and out of the position so often that, we've actually made a decent amount of money, and including the interest, we made even more. Look at the difference inflation rates between the US and the Swiss economy. You can see that the US is a lot higher than the Swiss economy, meaning the Swiss National Bank doesn't really have a reason to keep interest rates high, whereas the US probably wants to keep it higher for longer, as the market narrative has been for a little while. And that's further evidenced by the 10-year interest rate. So you can see the US 10-year interest rates is at 4.5%, and for the Swiss, it's only about 0.89%. So much, much lower. And this allows us to get this interest differential or this carry trade. Also, it really helps that the Swiss National Bank themselves want to keep the franc as weak as possible so that they can curb inflation. So now you know that we actually do want to hold this for a long period of time. Of course, price fluctuates and therefore, we need to risk manage in order not to get killed by the price movements of this. So the question is, how do we apply it? Well, in a different professional setting, you would have swaptions, futures, and different instruments to allow you to hedge this position. But of course, on eToro, we only have the Forex positions themselves, or the CFDs, to buy in and out at different levels so that we can average out the cost. Not really DCA, not really martingale, but just manage the price inflation so that when it mean reverts, we don't lose as much or even make money from the positions. So Forex trading is loosely defined into two main trading strategies. One is trend following, which is what you see here. A possible entry here, possible entry here, possible entry blah, blah, blah. And all technical analysis does, it allows you to express this view in mathematical formulas. So you can see here, these are just moving averages. And when it tests, then it's possible entries. And then when it drops below, it just exits, right? But again, this is just all math. And all these indicators are expressing is just math. So similarly, what I like to use is a mean reverting strategy. So this is a mean reverting strategy, which means that price tends to go in up or down, but it will revert back to the mean, ever so often. The indicator that you're looking at right now is called the TD or the mark sequential, which is it's kind of a complicated indicator, but I really, really like it because it forces you to ensure that price is kind of stopped moving in a certain direction, is consolidating before you enter. So instead of using the mark indicators, you can also use things like support and resistance, like here, or here, or here. So, entering it with 3 different levels at 3 different spots and, dollar cost averaging in or martingaling it. And this will allow you to control these like price movements from like getting way too out of hand. And in between, while you're waiting, you can collect that sweet, sweet interest. Now, it is a dangerous strategy and you do really need to watch your margin requirements when you do this kind of trade. That is also one of the reasons why I hold so much cash, is really to manage these risky positions. But I think it's a really good diversified way of getting returns, because if we're just depending on stocks moving in a single direction and it doesn't, it can be a bit risky. And also the US dollar tends to act inversely to the stock market. Not always, but at most times it does, as it's a safety trade. But yeah, for now, I'm really, really enjoying this pair, because even if we just buy and hold it, we get sweet interest. And prices go down, we can just buy more and then wait for it to mean revert and make some trading income off of it. So when I did the math on this trade, I think we made about 1 to 2%, which again may not sound like a lot, but considering that we made like 24% last year, so like 2% is not very much of the portfolio. But to me, as long as it provides diversified returns, it is definitely attractive to the portfolio. Remember, none of this is financial advice. Do your own research and consult a financial professional should you need it.